854 ounces. That's the amount of registered silver sitting in COMEX vaults, the category of metal that can actually be delivered against futures contracts. Not eligible, not theoretical. Registered, deliverable. And it showed up alongside a total COMEX silver inventory of roughly 390 million ounces, a split that looks harmless until you understand what it really means. And the strange part is how quickly the story compressed. Not months, not weeks. They said this kind of tension couldn't last in a modern electronic market. They said futures were liquid enough to smooth everything out. Yet here we are, staring at an inventory split that keeps widening at the exact moment silver is being pulled into new, non-negotiable uses. What makes this more than another commodity scare is the information asymmetry. Institutions don't wait for a headline. They watch the plumbing, they watch margin schedules, warehouse categories, vault tallies, delivery notices, and the quiet little numbers that rarely trend on social media. When those signals shift, big money moves first. The rest of the world hears about it later, usually after price has already done the damage. And what I'm about to lay out isn't a rumor, and it isn't a conspiracy. It's the market's own paperwork telling a story most people aren't reading. Welcome to Atlas Signal, where we decode what matters before it becomes the only thing anyone can talk about. If you're the kind of person who likes to understand the mechanism before the crowd discovers the narrative, you're in the right place. If you want to hear the story the data is telling, not the story that feels comfortable, stay close. And as you listen, drop a comment with where you're watching from, because this community has a way of spotting patterns early when we compare notes across the world. Now, let's get forensic about what actually happened. 854 ounces. Total silver across COMEX vaults was roughly 390 million ounces. Eligible bars meet the exchange's standards, but they belong to someone, and they aren't obligated to be delivered unless the owner chooses to register them. In a calm market, that distinction sits in the background. In a stressed market, it becomes the entire plot. Because while that registered figure hovered a little over 102 million ounces, demand signals were marching in the opposite direction. 9 million ounces, 5 million ounces in 2024, the fourth consecutive record year. That is not a one-off spike. That is structural. Solar, electrification, data centers, and the kind of electronics that quietly power everything from grid infrastructure to modern computing keep pulling silver into places where it is consumed, not stored. So you have one side of the ledger saying repeated deficits, record industrial pull, and rising strategic uses. And you have the other side of the ledger showing a deliverable inventory category that remains tight, even as headlines point to bigger totals that are not automatically available. And then there's the price behavior. When exchanges decide they don't like the level of heat in the room, they don't give speeches. They change the rules of entry. On December 29th, 2025, the CME raised margin requirements on March 2026 silver futures from about $22,000 to roughly $25,000 per contract. That's a $3,000 jump in collateral in a market that was already moving violently. If you're leveraged, a margin hike is a cold mechanical shock. It forces liquidation, not because someone changed their mind about silver, but because their financing terms changed overnight. That same playbook has shown up before. And this is where the hidden pattern matters. In 2008, when liquidity evaporated across markets, commodities didn't just fall, they were forced down as leverage unwound. The initial move looked like fundamentals didn't matter, but after the liquidation phase, the assets tied to real-world constraints began to reprice as the system stabilized. Silver was no exception. The lesson from that era was brutal and simple. The first move is often about funding, not about supply. In 2011, silver ran into the kind of speculative intensity that ends with a rule change. After a sharp rally, margin requirements were raised repeatedly, and the market snapped lower. The point isn't the drama of that year. The point is the mechanism. When positioning becomes crowded and volatility spikes, the exchange uses margins to reduce risk. That's not moral, it's plumbing. And the result is the same. Paper leverage gets squeezed out quickly, often right as the underlying physical story is getting more complicated. In 2020, when logistics broke and investors suddenly cared about possession, silver's physical premiums and delivery dynamics became the story. Futures prices and real-world availability didn't always line up neatly. The market learned again that paper silver and physical silver are related, but they are not identical in the short run. Now in 2026, the pattern is rhyming with a modern twist. Industrial demand is not only strong, it is getting locked in by long-term buildouts. At the same time, visible inventory categories that matter for delivery remain thin enough to keep the market sensitive to shocks. And that leads to the players. First, there's the exchange itself. CME is not a miner, not a refiner, not a consumer, but CME controls the collateral gates to the biggest paper silver arena in the world. When CME raises margins, it is effectively raising the cost of holding exposure. It is also shortening the leash on anyone relying on leverage. And because margin hikes tend to happen during volatility, they land like a hammer at the worst possible time for overstretched positions. Second, there are the vault systems and the entities that use them. COMEX warehouses publish inventories with categories that look like accounting, but function like a map of potential stress. Registered is deliverable. Eligible is potentially deliverable, but only if owners choose. And those owners include banks, ETFs, large holders, and industrial entities that may have different reasons for keeping metal in one status or another. Third, there's the London Vault System, where the LBMA reports the tonnage held in commercial vaults, 3% month over month, valued around $92 billion, equating to roughly 924,304 silver bars. That number is often used to imply abundance, but the market detail is in the direction and in the function. A small monthly decline sounds benign until you realize that steady drawdowns, even small ones, can reflect persistent pull from somewhere else in the chain. Here's where it gets interesting. These two systems, COMEX and London, are linked by flows, but they behave differently. COMEX is a delivery mechanism tied to futures. London is a storage and settlement hub for wholesale bullion. A ton in London is not automatically a deliverable ounce in COMEX, and that is exactly why dislocations happen. So let's talk about the dislocation, because it's the heart of the current moment. On paper, silver can look plentiful. Total COMEX inventory is near 390 million ounces. London vaults in the tens of thousands of tons. ETFs holding massive quantities. Headlines that suggest supply is fine. But the deliverable categories and the consistent deficit numbers say something else entirely. 9 million ounce deficit in 2024. That means the world used nearly 149 million ounces more than it supplied that year. And it wasn't just investment demand doing the pulling. 5 million ounces, a record. That gap between paper comfort and physical reality shows up in several ways. One of them is the difference between eligible and registered inventory. If registered stays low while eligible is higher, the market is effectively saying the metal is there, but it's not volunteering. And metal that isn't volunteering matters when delivery pressure arrives. Another is the difference between quoted prices and physical premiums. Even when futures prices fall on a margin-driven liquidation, physical availability and premiums may not relax in sync because the liquidation is a financial event, not a mining event. A forced seller in futures doesn't create new bars. It just changes who holds exposure. And another is geography. When industrial demand is rising in regions building out electrification, solar capacity, and high-density computing infrastructure, the flow of silver tends to follow manufacturing supply chains. That can tighten availability in one hub, even if another hub still reports large totals. Now, you might be thinking, if London has 27,729 tons, and COMEX has hundreds of millions of ounces total, why should anyone care about 102 million ounces registered? Because markets don't break when totals look big. They break when the deliverable float gets small relative to the promises tied to it. Imagine a stadium with 390,000 seats. That sounds enormous. But only 102,000 of those seats are actually open to the public. The rest are reserved behind doors that only open if the owners feel like it. On a normal day, nobody notices. On a day when 150,000 people show up with tickets that say guaranteed entry, the difference between exists and accessible becomes chaos. That is what registered inventory represents. It is the open seats. And when the open seats stay tight while the crowd grows more determined, volatility doesn't disappear. It intensifies. Now, let's simplify the mechanism of how we got a silver snap move without falling into the trap of treating it like a single cause. Start with the structural pull. 5 million ounces in 2024. That demand is sticky because it's tied to products and infrastructure that get built on schedules. A solar panel manufacturer can't tell a utility, sorry, we're waiting for prices to calm down. A data center build-out doesn't pause because a futures contract had a bad week. These are long pipelines. Next, add the deficit. 9 million ounce deficit in 2024 means inventory somewhere had to fill the gap. Deficits can be absorbed for a time by drawing down above ground stocks, but persistent deficits are not neutral. They reduce buffers. They turn minor disruptions into major events. Then, add the leverage layer. Futures markets allow enormous notional exposure with relatively small collateral. When price is rising, leverage looks like a gift. When volatility rises, leverage becomes a liability. And when the exchange raises margin requirements from about $22,000 to roughly $25,000 per March 2026 silver contract, that liability becomes immediate. People who can't post the extra collateral get forced out. Forced exits create sharp price drops. Sharp drops create more margin calls. The cycle feeds itself. That cycle explains why a market can fall hard even while the longer-term physical pull remains. It also explains why institutions watch margin schedules like hawks. If you know a margin hike is coming, you can reduce risk before the forced liquidation wave hits. If you find out after the wave hits, you're reacting. This is the part no one is discussing in plain language. Margin changes are not just risk management. They are liquidity events. They change who is allowed to stay in the trade. Now, tie that back to inventory. If registered inventory is thin and the market becomes volatile, the system becomes more fragile. Why? Because volatility discourages calm conversion from eligible to registered. Owners of metal may prefer to keep optionality. They can wait, they can negotiate, they can hold back. And when optionality dominates, the deliverable float can remain tight, even if total reported inventories look fine. So what does the evidence say in numbers, not feelings? 854 ounces on February 9th, 2026. It says total COMEX silver around 390 million ounces, 3% from the prior month. 9 million ounces in 2024. 5 million ounces in 2024, a record. Those are not opinions. Those are the numbers the market itself published. Now let's connect the dots between those numbers, because the implication is where the tension lives. 5 million ounces, then above ground inventories become the shock absorber. But shock absorbers wear out. When they wear out, the market's price discovery has to do the work that inventory used to do. And price discovery in a leveraged futures market is rarely gentle. At the same time, the existence of large vault totals can create a false sense of security. Those totals include metal that may already be spoken for, metal held as collateral, metal owned by entities with no incentive to make it deliverable at today's terms, and metal sitting in forms or locations that don't flow easily into the exact channel under stress. Availability is not just how much exists, it is how much can move at what price, on what timeline, with what permissions. When industrial demand is climbing, permissions tighten, contracts lock in, supply chains get managed, and the metal becomes less free. That's why a market can feel simultaneously abundant and scarce, depending on which metric you watch. Now, forward analysis in this context isn't about calling a price. It's about recognizing what this kind of setup has led to historically. Historically, when you have persistent deficits and tightening buffers, the market tends to alternate between two regimes. The first is liquidation shocks, where price falls violently because leverage is being flushed. The second is repricing waves, where price rises because the physical reality asserts itself after the financial purge. If the deficit trend continues, one conservative scenario is that volatility stays elevated while the market slowly adjusts through higher recycling, substitution where possible, and incremental supply response. In that scenario, you would watch whether the annual deficit narrows meaningfully and whether registered inventory rebuilds without being immediately drained. A moderate scenario is that industrial demand remains strong enough that inventories continue to be drawn down, and the market begins to express that tightness through persistent physical premiums and periodic spikes in futures when delivery pressure rises. In that scenario, you would watch the spread between deliverable categories and total categories, and you would watch for repeated margin actions, because exchanges tend to respond when volatility refuses to calm. An aggressive scenario is that a supply chain disruption, a policy change, or a sudden surge in investment demand hits at the wrong time, when buffers are already thin and forces a rapid repricing. In that scenario, you would watch the pace of registered inventory changes, the behavior of London Vault holdings month to month, and the way futures react to delivery cycles. The exact trigger is unknowable, but the vulnerability is measurable. And that brings us to the divide. There are always two kinds of market participants, not smart versus dumb, not insiders versus outsiders in a dramatic sense, just those who track the plumbing and those who track the headlines. The plumbing people notice when registered inventory is thin, even as totals look big. They notice when a margin hike forces liquidation. They notice when industrial demand keeps printing records even after a price crash. They see that the story isn't linear. The headline, people see a price chart and assume the move explains the world. They think a fall means problem solved and a rise means bubble. But commodities tied to real-world use don't behave that neatly, especially when the financial layer is leveraged and the physical layer is constrained by logistics and contracts. The information gap becomes a wealth gap, not because anyone is magical, but because timing matters. Institutions adjust risk before the crowd. They reduce exposure before margin hikes bite. They accumulate or hedge when the market is quiet, not when it's panicking. Retail tends to move last, reacting to the same data after it has already been reflected in price. So the question isn't whether silver has demand, 5 million ounces of industrial demand in 2024. The question isn't whether deficits matter, 9 million ounces short in 2024. The question is whether the market's delivery plumbing can stay calm when the deliverable float remains tight and the leverage layer keeps getting jolted by margin and volatility. To understand why this moment feels different, zoom in on how industrial demand has evolved. For decades, silver bounced between monetary metal and industrial input. In the last few years, the industrial side stopped being a background character. Solar manufacturing uses silver in tiny amounts per panel, but the scale is enormous. Add electrified vehicles, charging infrastructure, power electronics, and the relentless build-out of high-density computing. 5 million ounces in 2024 matters. It's not a narrative, it's a throughput number. Now layer on the market's habit of treating silver like a leveraged cousin of gold. When prices accelerate, traders pile in because silver historically moves faster. That sets the stage for the exchange response. The late December 2025 episode showed it in real time. Silver had surged from roughly $30 earlier in the year to near $80 an ounce. Then the margin schedule changed, with initial margin for the March 2026 contract rising from about $22,000 to roughly $25,000. The same exposure suddenly required more cash, immediately, with no debate. This is not new. In 2011, after a powerful rally, repeated margin hikes helped trigger a violent reversal. The lesson was simple. Leverage can be correct on direction and still get destroyed by financing terms. When you see a sell-off that coincides with a margin hike, the key question is not, did demand vanish? The key question is how much paper exposure was dependent on cheap collateral. That question matters because the paper layer can move faster than the physical layer. Futures contracts can be created and traded instantly, but bars can't be mined, refined, and shipped instantly. So the price can overshoot in both directions. On the way up, leverage amplifies the move. On the way down, margin calls accelerate it. If you only watch price, it looks like the market is changing its mind. If you watch inventories and demand, it looks like the market is flushing positioning and then rechecking reality. So what should be watched next? Specifically, if you want to track whether this tension is easing or building, watch the registered category daily as a trend. Watch the relationship between registered and eligible. If eligible rises while registered stagnates, that is optionality. If both decline together, that is outflow. Watch the London Vault data month to month. 3% decline sounds small until you see a string of declines. Persistent drawdowns are a slow motion signal. Watch margin policy. When an exchange raises collateral or shifts to percentage-based requirements, it is reacting to volatility and risk. Those changes alter who can hold exposure and how quickly positioning can unwind. And watch the narrative mismatch. If commentary insists there is plenty of silver, but deficit data keeps printing large negative numbers and deliverable inventory remains thin, that mismatch eventually resolves. It resolves by new supply arriving, demand falling, or price adjusting to ration the metal. Historically, the resolution is rarely a straight line. It comes in bursts. Remember the 2020 logistics crunch when futures prices and real-world availability didn't line up neatly. Dealers reported delays, small bars carried stubborn premiums, and available metal turned into available in the right form at the right place on the right timeline. That's the same principle behind the COMEX split. Total inventory can look comfortable, while deliverable inventory stays thin. London's 27,729 tons is a headline figure, but a ton in London is not automatically an ounce ready for a specific futures delivery mechanism tomorrow morning. In stressed markets, that conversion depends on incentives, trust, and time, and those are never infinite either. This is Atlas Signal, where we decode what matters before its headlines. If this connected dots you hadn't lined up before, you know what to do. Because the real edge isn't drama, it's clarity. And the question isn't whether this story unfolds. The question is whether you recognize the pattern while the numbers are still quietly telling it.